Hi everybody, it's Steve Griffiths here, developer of the MTPredictor software program. In this video I'd like to look at system trading, but before we start I'd like to have a quick look at our risk disclaimer, just to remind you that all examples in these videos should be considered as hypothetical. No trades were taken, they're just shown for illustration and training purposes only, and there's a risk of loss in trading and investing. All professional traders know and understand that losses can and will and do happen. I'll just say that again, losses can and will and do happen. All trade decisions are your own sole responsibility. Right, this is not how we suggest you trade MTPredictor. The reason being is because, as we'll see throughout this video, markets go in cycles, and the best way to trade is to only trade when the market's in a good cycle. So what are we looking at here? Well, what we've done here is back from the 10th of December 2010, when we started our MTPredictor training room, up to 28th of January 2016, so that's about 5 years. What we did here is we followed the YM on a 3-minute time frame using our automatic trade setups, our automatic trade signals. We then manage them in accordance with our standard MTPredictor trading guidelines. In other words, we take profits at the target. Unless the STF is strong, then we run with the ATR stop, and all the trades are filtered in the STF trade directions. In other words, the base standard trade management guidelines. I'm not presenting these for a look at a performance. What I want to do is look at how markets go in cycles and show you a tip that professional fund managers use to help you in this. Because you'll see here that there are periods when the signals go through a profitable time, then there are periods when they go through a losing time. You can see overall we actually did quite well. We actually returned 239% and over those 5 years, which is very good indeed. Just wanted to show you as well on the account settings here is that we actually assumed a round turn slippage per contract of $5 and commission per contract of $5 as well. So this is actually quite severe in that we are assuming slippage on every single contract. So that does takes a lot out of the bottom line. But we wanted to make it look fair. Right, so let's see what can happen when you're system trading. Again, this is why I don't like black box system trading myself. So say, for example, here, let's have a look at the worst drawdown we had during this particular time. You can see here the worst drawdown was 42%, which is a very severe drawdown. So let's look here, which was from about trade 1158 into trade 1236. So I'm looking at just this particular period here. So if we look at this and recalculate, oops, that's not what I wanted to do. I wanted to recalculate into 1236. There we go. Recalculate. So this is that drawdown period, and this is what can happen when you're trading 100% mechanical system. So you can hit just at the wrong time. So say you came into our system here on basically the 26th of September, all the way down to here, which was basically to mid-December, so almost 3 months just straight losses going all the way down. So if you'd looked at our system or this system during those 3 months, you'd have thought it was a really bad system, just made straight losers. But let's see what happened a little while later. If we just move forward, whoops, if we move forward to bar 1482, recalculate, look what happened just after that. There's the drawdown. Then after that you had an absolutely massive rise, and again, this is what can happen after drawdowns. You get profitable times here. Now, of course, it's very difficult to sit through a drawdown like this, and I don't suggest anyone does that. Again, that's why I don't like trading mechanical systems. So what I want to look at in this video is there a way that if you are trading a mechanical system or trading anything sort of systematically, is there any way you can avoid these drawdowns and take advantage while the market's going in your favor? Well, if I just go back to look at all the data again, which is here, let's have a look at it in total. What I've done is I've actually put a 20 period moving average on the actual results, and this is a technique used by fund managers. So what they do is when you're following your results, you follow all the results, but you only actually trade when your results are above the 20 period moving average. So in other words, again, let's go back and have a look at this particular period here. So let's go into say 1140 to about here somewhere 1342. Recalculate here. So what you'd have done is once your equity curve went below your moving average, which it did on where is that? That's on the 10th of March 2014. It's below your moving average. You can see that all the way to here. You would not have been trading. In other words, you've just been sitting aside, following the actual trades in the spreadsheet, but not actually trading them. So you'd have avoided this loss. Then it went above the equity curve there. You'd done 1-2 trades, then back below again, and then you'd have avoided all the way down here. Came back above here. You then have been traded, down, not traded, above, traded, above, traded. So you can see what I'm suggesting in that. What you do is you place the 20 period moving average. I'm just suggesting 20 periods because it's a good smooth average to use. So you only trade when your equity curve is above the 20 period moving average. So let's have a look at what difference that would have made. So rather than having an equity curve that has very large runs up, very large runs down, very large runs up, very large runs down, which is very spiky, and as you can see can have a quite severe drawdown, which then obviously was followed by a huge rally. But let's see what it would do by just trading when you're above the 20 period moving average, which is these set of results. Can you see here, suddenly it smooths the equity curve down immensely. So you've gone down from an equity curve that's up, down, up, down, up, down, up, down, up, down, like this, even though it's going up overall, into an equity curve that's very much smoother, a lot smoother. So in other words, you take advantage of only placing your trades when your system is in a good part of the cycle, and not placing your trades when the system is in a bad part of the cycle, and that means your drawdowns are far less. Because if we look at the first one, the maximum drawdown here was 42%, which is well, unsustainable for anyone who catches it just at the wrong time. But if we now look at this one, the maximum drawdown is only 8.9 or 9%. Also, the return on equity goes up as well, because obviously you're not taking losses into account. So here, over the 5-year period, it was just over 500% return, whereas trading the raw signals, it was 230. So you pretty much doubled your profit. But the main thing is you reduced the drawdown significantly. In other words, keeping out of the times when your particular trading methodology, it doesn't have to be MTPredictor, it can be any trading methodology, is in a drawdown. So even though I don't suggest trading MTPredictor like this, in other words, I don't believe that you should trade any system 100% of the time because markets go in cycles, and this is a very good example showing these cycles here. You can see the green line, it has lovely smooth cycles where you have profitable cycle, a losing cycle, profitable cycle, losing cycle, profitable cycle, losing cycle. So this is what I mean when I say the markets go through cycles. So one way to get around this is follow the system you're using 100% of the time, plot a 20 period moving average on those results, and then only actually trade when your system is above the 20 period moving average. Then don't trade when it's below. So trade when it's above, don't trade when it's below. In this way you can avoid these big drawdowns and still take advantage of when the system is in a good phase and going with you. So I hope that's been a good tip, and it's something that professional fund managers tend to do, and it's one way to look to smooth out your equity curve. Again, it changes this equity curve here, which is very spiky, into something that's a lot smoother and a lot easier to handle. But also, another reason why I'm doing this video is you can see here the cyclical nature of trading, and how your profits and losses go in cycles. So again, a good way to change a very spiky equity curve into something that's a lot smoother.